Good evening, participants. Morningstar is present in 29 countries with a combined AUM of 260 billion USD, which is respected across continents for its quality research of different financial products. Mr. Dhaval Kapadia, Director and Portfolio Specialist, who is leading managed portfolios, is going to be the keynote speaker today, and he is going to give his views on Central Budget 22, Morningstar's managed portfolio. Mr. Dhaval Kapadia brings in about 23 years of experience in fixed income, equity, investment advisory. He is a CFA chartered holder. And I hand over the stage to Mr. Dhaval.
Thank you, Mr. Sivaram. It's good to be here, and thank you for inviting me for this session today. I'll just share my screen so that we can kick off. So I've got a brief presentation where I'll talk through our views on the budget. Obviously, it was announced a couple of days ago, and of course, alongside what our outlook is for markets, not just in 2022, but going ahead over the next few years as such. So that's what I'll try and cover during today's session. And obviously, feel free to sort of post your questions. We will be between Sivaram and me, we'll try and address your questions towards the end of the presentation as such. So just before we sort of kick off on our views on the budget, just a little bit about Morningstar. This is a company that was set up in 1984. It is headquartered in the US, and in fact, the shares are also listed on the Nasdaq Stock Exchange. And initially, this company was set up to provide data and research on mutual funds. For individual or end investors in the US. At that point of time, in the 1980s, there wasn't much information about mutual funds that was available for end investors, and our founders set up this company to provide research and data on mutual funds, like I said. And over a period of time, we've tried to build a trusted name in independent investment research, and we provide data on more than 600,000 investment products worldwide. And currently, we are present in about 29 countries, employing more than 9,000 people, across these countries. And more importantly, is our mission, which has always been to empower investor success, right? So what that means essentially is that our mission is to create great financial products that help investors achieve their financial goals. So that's the sort of the foundation of the company, and that's what we strive for on a day-to-day kind of a basis as well. Just looking a little bit more closely at the investment management group within Morningstar. Now, this is the team that I and my colleagues are part of globally, and this team is responsible for providing investment advisory and portfolio management solutions to end investors. And typically, to provide these solutions, we partner with advisors or wealth managers or platforms or PMS platforms such as PMS, Bazaar as such. So we partner with these entities to provide these solutions to the end investors as such. And this group, our group, the investment management group, consists of about 550 odd people, out of which 95 odd people are investment professionals. So effectively, their day-to-day job is to track markets, build views on asset classes, manage money, review portfolios, and so on and so forth. So, the group and the company has invested to a fairly good degree to build a strong team, which is essential to run an investment business as such. Now, sitting out here, how do we leverage our global resources? And we have large teams at different locations, as I mentioned, and which is sort of visible on the map out here as well. So the way the group is structured is into three regions: Americas, EMEA, and Asia Pacific. And within each of the three regions, there is a hub or a center of excellence that's been identified, where we have a large investment team, and the countries within that region work closely with that team to build investment solutions for the local market. So for instance, within Asia Pacific, Sydney in Australia is the hub or center of excellence. We have a large investment team there. And me and my team and other countries within the Asia Pacific region that are listed here work closely with the Australian team to build solutions for the local market, to review our asset class calls and so on and so forth. So that way we are able to combine our local portfolio management or investment experience along with our global resources, and then we're able to leverage these global resources that we've built over the last several years as such. Just coming back to the main topic or agenda for today's discussion, obviously it's on the union budget, and obviously the budget comes at an interesting time, right? I mean, globally we are seeing some turmoil in the markets, concerns around inflation, and central banks, particularly the Federal Reserve, expected to act on trying to curb inflation. Inflation in the US has, is at the highest level that they've seen for the last 4 decades, right? And that is, in fact, at this point of time, CPI inflation in the US is higher than in India. Right now, that is like almost unheard of for a very, very long time. So, these are interesting times, so to say, and we had obviously an interesting budget that came through a couple of days ago. And clearly, just before the budget, I mean, there was a lot of talk and discussion around, whether the government will go, given that some state elections are coming up, whether the government will go and try and provide some SOPs and some sort of, measures to try and help to boost their chances or electoral chances as such, or, whether they would try to provide some SOPs to, to taxpayers to try and boost consumption and so on, or whether they would go the capital expenditure route. So clearly, if you look at the budget, they've opted for the second route, which is focused primarily on capital expenditure to try and boost the economy. Right, so that is the core theme of the budget, along with obviously social sector initiatives, which are very essential, whether it's around health, education, water, and so on. Along with that, the core focus is around capital expenditure. And in fact, if you look at some of the numbers, and we'll talk through some of these in more detail as well as we go ahead. But just from a broader or an overview kind of a perspective, the capital expenditure for the current fiscal year is budgeted to rise by about almost 25% over what we saw in the previous year. So, that's a substantial increase in capital expenditure spending. And as we're saying, most of this is targeted towards building more roads, highways and railway, and, extending the railway network and so on and so forth. So that's a key component or a key, driving factor of this budget. And that's how they think, the economic growth could revive and sustain over a period of time. But specifically, if you look at the GDP growth that has been projected in the budget, right now, they use this GDP growth number to derive revenue projections, to derive other projections as well, or estimates. This seems to be a little bit conservative. Now, this is the nominal GDP growth rate, so it includes obviously inflation as a component, and the budget projections put it at about 11%, whereas the Reserve Bank of India itself is projecting current year GDP to be, or rather I would say next financial year GDP to be about 13 to 13.5% on a nominal basis. So the government seems to have been a little bit conservative in their projection for growth rate, when it comes to the economy as a whole. Alongside, the capital expenditure drive, some of the other schemes which have worked well during the pandemic, such as the ECLGS scheme, which was essentially providing, a guarantee cover for particularly for small and medium enterprises so that they are in a better position to borrow money and banks are more comfortable lending to them. So this cover has been extended by about 50,000 crores to about 5 lakh crores, and a good chunk of it has been used previously. So therefore you see some of this extension, and the additional amount is primarily focused towards hospitality and the other contact sensitive kind of sectors or industries which have been impacted across these various waves that we've seen over the last couple of years or so. Another sort of important announcement which people were sort of in a way anticipating or hoping to hear something on. So one is the government has announced that the RBI will issue a digital currency, right? So this is they've just said it will happen during the course of the financial year, and obviously one can expect to hear more. The monetary policy is due next week, so the RBI, I mean, one will have to wait and watch if they make any comments around that. But that's an important move to try and promote digitization and launch digital currency that's sort of owned and sort of put out by the government and the Reserve Bank of India. So that's an important move. They've also introduced taxes on cryptos in a way. So people are viewing this in different ways. One is, some people think in a way this is the legalization of cryptos. Government officials are not very clear around that aspect as such, but that's an important announcement, at least, that there seems to be a recognition of cryptos, but yeah, the legality and so on is still being debated. From a telecom perspective, the government has announced auctions that they will conduct auctions for the 5G mobile, 5G spectrum as such. Again, this was in a way anticipated, but that's good again from a digitization perspective, helping further expansion of the digital sort of economy as such, which has gained obviously a lot of traction over the last couple of years, in particular during the pandemic. Besides that, again, the government has seen over the last year and a half good success in the PLI scheme, which is a production linked incentive scheme, which is to try and they started with a few sectors, and now they continue to expand that on an ongoing basis. So here they provide certain incentives for companies to set up manufacturing facilities in India and to grow their revenues and export and also build export revenues through those manufacturing facilities. So now another about 15,000 crores has been allocated for PLIs in some of the sectors that are mentioned here, whether it is large-scale electronics, IT, hardware, pharma, and so on, to try and boost local manufacturing. Again, this is sort of positive from a point of view that over the last few decades, India has not really grown too much on the manufacturing side. It's the services sector that has done very well, but the services sector can employ only a certain number of people, right? So manufacturing can employ many more people. China and some of the Southeast Asian countries have seen a lot of success in that area, so the government is trying to make its space in the manufacturing segment as well. Like I said earlier, unfortunately there were no direct consumption swaps or boosts that were provided. There were expectations that that the government might tinker around with the personal income tax rates or hike standard deduction limits or other things to try and incentivize the middle class or the taxpayer to sort of consume or increase their consumption, but that doesn't seem to have happened at all in this budget. And net, if you look at it from the impact of the expenditure and the revenues, which is a reflection in the fiscal deficit. So the government has chosen to retain a relatively higher level of fiscal deficit. Obviously, it's lower than last year. For FY22, the fiscal deficit is now estimated at about 6.9%, which is a revised estimate. For the coming year, it will be about 6.4%. If you go back a few years, the fiscal deficit was much lower at about 3.5% to 4%. Post the pandemic, last couple of years, the government has to try and boost or support the economy. They've chosen to expand the fiscal deficit, which is probably the right move. They need to support the economy, and although they've laid down a consolidation path over which they intend to reduce the fiscal deficit over the next few years, but at least current year, although it's slightly lower than last year, but it's still fairly large in that sense, and due to which the government borrowing program is also much larger than last year. So they will need to fund or finance the fiscal deficit as well. And there has been some impact on interest rates already in the bond market, and we'll talk more about this as we go ahead as such. I'll not spend too much time here. There are a fair bit of numbers out here, but I don't want to go through all of them. But I think some of the key factors, which I mentioned earlier, the fiscal deficit being, sort of lower than last year, but generally higher than the longer term trend. And due to which, we are seeing that the government, as I mentioned earlier, the government might need to borrow more money, and which is what has concerned the debt markets, right? And although the RBI hasn't done anything to increase interest rates as yet, but already interest rates in the bond market, and I was just looking at some of the numbers, for the last 1 year or so, the 10-year bond yield on government securities, or the 10-year GSEC yield has gone up by about almost 100 basis points or 1%, right? So it is important from a market perspective because lending for corporate bond lending rates or other rates are linked to the government securities yield as such. So in a way that's an area of concern for the Reserve Bank, in terms of, and we'll wait and watch in the upcoming monetary policy, how they sort of react to that. The market is sort of waiting to hear them on that front as well. And the other thing about, we spoke a little bit about the expenditure side, where capital expenditure is going to grow by about, almost 25%. On the other hand, in terms of the revenues, the government has been a little bit conservative in terms of their tax revenue estimates, right? And this is now expected to grow at about 9.5% or so, and which is in fact lower than the nominal GDP rate that they themselves have projected. And if you look at previous years, the growth has been stronger from a tax revenue perspective. Last year, of course, the base in FY21 was lower, so the last year growth rate was high. But even previous years, the growth rate has been better, and therefore one would anticipate that, or one, at least on first reading, it seems that the government is being a little bit conservative when they're talking of the tax revenues. Some of the other areas, again on the disinvestment side, has been a challenging period for the government to raise or to meet their targets. Obviously, this year, just after the budget, in fact, they spoke about the LIC IPO hopefully coming, in March itself, and that's what they seem to be pushing for. That should help them sort of up their disinvestment numbers. But broadly speaking, the government's focus, particularly over the last couple of years, has been to try and privatize or sell off assets wherever they feel that the strategic interest or strategic involvement is not required by the government, right? So you're seeing some of those. Obviously, with Air India, we saw that very recently. We saw with with some of the steel plants as well, where they sold off to a Tata Group company again, and some other large disinvestments are lined up for next year as such. Although they have estimated lower amounts, I think probably they are being a bit conservative, given that they haven't seen very strong success, or disinvestment has taken longer than they have anticipated. So they seem to be a little bit conservative on their estimates on that front as such. So just moving on, and again, I'd just like to focus here on the capital expenditure, in terms of how it has been divided. And so therefore, I'll request you to look at the table that's there on the right side. There is other data which talks of how the total expenditure is split. But like I said, one key sort of driver for the budget is capital expenditure, and how have they split this, and how is the growth versus previous year. So if you look at the biggest growth, in a way, is coming towards expanding the road network and highways. So about 55% growth in the allocation for roads, road transport and highways as such, so which is a substantial growth. And again, it's one of the larger components within CAPEX. Besides that, again, their allocation to railways is also up, defense and housing and others as well. So net, I think, there are several segments within CAPEX which, the government is trying to push, expenditure. The idea is that, obviously, through increasing government expenditure, they believe they will be able to bring in private investment, right? So if you look at the last few years, the challenge has been that the private sector has really not come out and made any significant capital investment. So that means not too many companies have expanded their plants or their manufacturing facilities and so on and so forth, right? So the government is trying to increase their expenditure and therefore try and get the private sector to also, invest more. Now, for instance, on the defense side, they've said that 68% of the procurement for the coming fiscal year will be done from, the domestic side. So, from companies or plants that are set up domestically, they will be 68% of the procurement will happen from those facilities vis-a-vis, imports and things like that. So clearly, the focus is to try and boost, domestic manufacturing as such. Just quickly looking now, I'll spend some time and very quickly try and talk through, the impact of some of these measures on various sectors, right? And, sort of starting with the financial sector, clearly we are seeing that, the boost to infrastructure, or rather, capex growth and to drive infrastructure growth, along with certain other sort of schemes like the extension of the ECLGS scheme. Now, all of this should in a way help, banks increase their the credit offtake, right? So that's been a challenge again over the last few years, where credit growth or the lending book of banks has grown very, very marginally, just barely single digit or 5-6% kind of a growth, and a bulk of that growth has come through the retail side. So for people that are taking housing loans or people that are taking auto loans and so on, that's where a bulk of the growth has come through. So now, with this push on the infra side, the expectation is that, credit growth for banks should also improve. Of course, over the last few years, banks have also cleaned up their balance sheets. NPA levels have come down. We've also had the bad bank being created. So, all of that put together should help, financials. Therefore, the impact on financials, should be positive as such. Along with that, of course, they've also said that they will make some amendments to the, insolvency and bankruptcy code and so on, which will again, probably help banks to sort of, recover some of their NPAs and resolve those issues, in a faster way. So overall positive for financials. Similarly for capital goods as well, as you would have guessed, given all the measures, and more specifically, the government has said that, they intend to expand the highway network by about 25,000 kilometers right now. If you go back about 5-6 years, I mean before 2014, the actual road development was much lower on an average as compared to what's happened over the last couple of years. So the government is trying to push building the highway network further. Along with that, they've also spoken of things like building a large number of cargo terminals, not just highway networks, but even rural road networks is what they want to sort of increase. They're also trying to push capex through state governments. So they again, for state governments, they're providing 50-year interest-free loans, and the allocation for that has increased from about 15,000 crores to 1 lakh crores. Now, again, they try to push states to also try and get them moving on the capex front, and obviously the metro and the MRTS. So net, obviously for capital goods companies and the sector as a whole, it will be sort of the budget is overall sort of positive. And again, sectors like cement, industrials, very similar kind of trends, because all of these are linked to the capex story. If you construct more roads, if you're going to construct more houses, and and also things like the allocation to projects such as the Jal Jeevan mission, where they're trying to provide water to rural households. So all of these would in a way act as a boost for cement and sort of industrial kind of sectors and companies. Within the railway side, they've said that they will over the next 3 years manufacture about 400 Vande Bharat trains with better energy efficiency and so on and so forth. So again, that's a boost for companies that are providing components or parts to a lot of these for the manufacture of these kind of goods as such. So overall, we think it's positive for both cement and industrials. Power as well. I think the focus has been more towards renewable energy, and therefore within that, of course, solar energy is a key area that the government is focusing on, and they've sort of they've created a PLI scheme as well for solar equipment, and they're allocating over the next few years about 20,000 odd crores to facilitate domestic manufacturing solar panels and so on and so forth. So that's again a thrust for solar energy and sort of local manufacturing as well. Another interesting thing that the government has announced is that is at a sovereign level they will issue green bonds. Right now, again, this is to try and gain access to long-term funding costs or lower long-term funding costs for renewable energy kind of projects as such. So that's an interesting announcement as well from the government. Again, so therefore, broadly, I think it's fairly positive for the power sector. Now, looking at pharma and healthcare, we think the measures are sort of overall the impact would be neutral on pharma and healthcare. On the one hand, the healthcare budget is the growth rate is fairly low versus last year, so that hasn't grown much. But on the other hand, to pharma, again the government is focusing on PLI, so therefore the allocation for PLIs in pharma has sort of gone up, and separately for the National Health Mission and some of the social sector kind of initiatives as well, the outlay is sort of fairly large as such, and this would in a way benefit obviously improving coverage of health services and so on. So in a way broadly neutral for the pharma sector is the way we see this. And if you look at oil and gas, the government hasn't really done much in this space during the budget. They've sort of the subsidy provisioning is much lower as compared to last year, and they've also spoken about an additional excise duty on unblended fuel as such, which would be levied from 1st of October. So again, out here the government is trying to push for blending of fuel, which as far as we understand, a bulk of the fuel that's used is blended fuel in some measure or the other. So the government is trying to push more on that front. So therefore they're increasing the cost of using unblended fuel as such. So in a way it's not overall the way we see it, because there have been too many provisions, and in fact the subsidy provision has come down. So we think it's negative for oil and gas, because given the fact that fuel prices have been rising, there is a risk that the subsidy might need to increase going ahead as such. Just quickly covering a couple of other sectors now. If you look at fertilizer or rather agriculture, some of the key measures include fertilizer subsidy, which again the rural segment in a way watches out for. So this has been reduced by lowered by about 25% and which we think in a way would be negative for the farming sector. Some of the other measures are slightly more positive, like some of the projects that they've announced, which would supply water across some of the rural areas as such, and then the use of Kisan drones as such. But overall, on the balance, it seems that it's sort of the impact would be negative, given that the fertilizer subsidy has been lowered by about 25% or so. For auto, again, broadly speaking, if the government is pushing for more construction of more roads, railways, and ports, it would tend to push purchase of autos. For instance, particularly a high capex push would help the consumer or the commercial vehicles kind of segment. And separately, of course, the government is also focusing again out here on electric vehicles as such. So therefore, things like duty reductions, and also if the government has to push for more usage of EVs, they will need to create EV charging infrastructure, right? And probably the government seems to be realizing that India is quite behind the curve when it comes to creating that charging infrastructure. Now, if you compare India to a China or some of the other major countries, they are significantly ahead. So India has not really created enough charging stations for people to use, like you have petrol pumps and so on. The charging stations are very, very few across the country. So therefore, if the government thinks that probably an option to that could be the battery swapping policy. They haven't come out with too many details on that, but they've indicated that they will come out with a policy where if your battery that you're using in a two-wheeler or four-wheeler runs out of charge, you simply replace it. You go to a place and you have it replaced out there with a fully charged kind of a battery. So you don't need to by yourself need to charge that battery. You just simply replace or swap that battery. But yeah, they've just announced that they will come up with that policy, so that will be interesting to sort of watch out for. And in a way, it would act as a boost for EVs, if it works out well as such. But overall, for auto, we thought this was sort of, the budget was sort of neutral for them, for that sector. And for consumer durables, again, largely we would think it's positive, given that the spend towards, say increasing the social sector and particularly increasing water supply and so on, that might sort of boost the demand over a period of time for things like washing machines and water purifiers and things like that. So mildly positive for consumer durables, and of course the PLI scheme for solar equipment again would sort of boost the demand for consumer durables as such. And finally, around the other main sectors such as metals, again, given all of this capex push that we've been talking of, fairly positive for metals, and similarly for telecom, more neutral, because obviously the 5G spectrum has been announced, but nothing major beyond that as such. There is a small PLI for 5G equipment. It's not very significant. So, but no other major announcements for the telecom sector. So, in that sense, neutral. Of course, broadly speaking, as digitalization and digital connectivity increase, that would benefit telecom companies as such over the longer term. And finally, on real estate, again, fairly positive, because the government's push towards constructing more houses. So again, some of the schemes that are focused towards rural housing, the allocation is fairly reasonable on those fronts. So again, this would be sort of positive for the real estate sector. And the government has also indicated that they want to try and improve the approval kind of process and mechanism, so that construction can happen much faster as such. So that's sort of a quick run through of the major budget proposals and the potential impact on various sectors as such. Now, just looking at the broader view on Indian equity markets as such, and we've obviously seen in recent times markets become a little more choppy. They've been more volatile over the last few weeks, of course, in line with what's happening globally, and of course, given the fact that markets have risen quite a bit, right, since the lows of March 2020, and if you look at valuations and particularly the price earnings ratio as such, given what we've seen in terms of the recovery in earnings starting to happen over the last year or so, valuations have moderated a bit. So if you look at the graph on the left hand side, it indicates the historical price to earning ratio. So this is the trailing P based on the last 12-month earnings, and here we are looking at the historical averages, which are the horizontal lines in between for large, mid, and small cap stocks. So they are, the trailing 12-month P's historically have been in the range of about 20 odd percent, 20 not percent, but 22 times or so. And the actual P's are the lines that you see moving, across these averages as such. So, till about last year, the P's were looking fairly high. One is, obviously, you had subdued earnings growth, in FY 20 and 21 on account of the pandemic. But since then, earnings has sort of, have started showing signs of recovery. And along with that, markets have also seen some correction. So PEs, may have moderated, although they are still above their long-term averages, right? So from that point of view, if you just look at valuation, markets seem to be slightly sort of overvalued at this point of time based on the historical or trailing 12-month P's as compared to their historical averages. Another way when we look at valuations is also try and look at the underlying fundamental, right? So which is the price to earning ratio has two components. One is the price, which is the stock price or the market index level, and the second component is the earnings, which is the denominator, right? So that is driven by various factors such as profit margins of companies or return on equity for companies and corporates, over periods of time. So what we see on the right hand side is how ROEs or return on equity for large, mid, and small cap stocks have moved over the last 20 odd years, about in fact 25 years plus, right? So, and what are the long-term ROEs for each of these segments? So for large caps, for instance, the long-term ROE is at about 17 to 18%. For mid-cap stocks, it's at about 13 odd percent, and for small caps at about 12 odd percent or so. So, but if you look at over the last few years, the actual ROEs for corporates have been lower than their longer-term averages. So, because of the slowdown in the economy and in a way the corporate sector not doing too well, leverage and other issues, sort of overcapacity build up and things like that, resulted in lower ROEs and profit margins, but which now we are seeing some of these starting to recover over the last 12 to 15 months or so. So in other words, as profit margins and ROEs for companies recover, these could act as a support to valuations as such for markets overall. Now, just another perspective, we were just talking about profit margins being lower over the last 15 or last about decade or so in particular. And another indicator of that is the corporate profit to GDP ratio, right? If you look at the graph on the top left-hand side corner, it indicates, the last about 20 odd years, how this ratio has moved. So what is the corporate profit as a percentage of overall GDP? And this number peaked in about 2008. And since then, you had seen a downturn till very recently, when you're now seeing, this also rise. So in other words, the point I was trying to make earlier also is that as corporate profits and margins and ROEs improve, this could provide some support to the market. So it is expected that this ratio over the next few years will sort of continue to improve, although it may be still lower from peak, but it is still sort of improving as compared to what we've seen over the last decade or so. Another factor that's been driving markets is the earnings growth expectation, right? And as of now, over the next 2 to 3 years, the expectation is that corporate earnings will grow anywhere in the range of 20 to 24%, right? Which is fairly strong growth, right? And the market in a way seems to be pricing this in. So they've priced in strong growth, but the market doesn't seem to be pricing in any near-term risks, right? Like for instance, the expectation that interest rates will go up, right? Globally and in India as well, as I mentioned earlier, that in the bond market already, yields have started to go up. So interest rates have already started to go up, although the RBI has not actually hiked interest rates. So how this will impact companies and their profitability doesn't seem to be priced in, or things like, high commodity prices as well. Companies are finding it difficult to pass on some of these high, commodity prices or input costs to the end consumer as such. So some of that might have an impact, so which doesn't seem to be priced in by markets. And therefore, if you look at the forward, valuation measures such as the 12-month forward, Nifty PE ratio, which is the top right-hand side, and the 12-month forward price to book ratio. Now, again, the 15-year average for the 1 year forward PE ratio is at about 18.2 times. Currently, the Nifty is trading at about 20 odd times, 20.7 times. Similarly, if you look at the price to book ratio, which is the at the bottom right-hand side chart, the long-term average is about 2.6 times, and currently, the way where markets are trading, the forward price to book ratio is at about 3.2 times. So, in short, these indicate that markets seem to have priced in the optimism and the positive factors, but not so much of the risk. So, therefore, in the near term, you're seeing last few weeks as well, markets turning quite volatile on various news items as such, and that's something that could happen going ahead as well. So net, we think that markets in India seem to be a little bit overvalued, and our return expectations from Indian equities are a bit lower at this point of time over the next few years as such. Now, just expanding, we've been talking a lot about and primarily about India, right? So Of late, we've seen obviously investors in India also start making investments in global markets, and therefore there is a fair bit of interest in terms of what's happening globally. Of course, what happens at least in major markets also has some impact on the local markets, right? So people do track what's happening on the US equity markets or other Asian markets or European markets as well. So just to give a little bit of a perspective in terms of what our views are across major markets worldwide, and I'll not go through each of them, but just a slightly broader kind of perspective. So at least, we believe that, obviously, US equities have seen a very strong run over the last 7 to 8 years, and particularly the big technology companies have had, the strongest run. They've significantly outperformed other companies in the S&P 500 and many other sectors worldwide as well. So overall, we think US equities are overvalued, and therefore our sort of return expectations from US equities are low. So therefore our conviction level is low to medium, right, for US equities. Other markets we think, such as whether it's UK or emerging markets, or for that matter China as well, probably offer a slightly better risk to reward at this juncture. So based on current valuation, some of the other markets are looking relatively more attractive. So therefore they carry a medium or a medium to high kind of conviction in some of the cases. And on the fixed income side, again, what's happened over the last few years is that, at least in developed markets, the central banks and the governments have been focusing on pushing up economic growth. They haven't been too concerned about inflation. And now all of a sudden over the last 4 to 5 months, they've realized that, all right, inflation is something that they need to focus on, the way, the inflation rates are rising in some of these countries. Besides the US and Europe as well, they're seeing inflation rates at multi-year highs as such. And therefore, historically, over the last few years, yields have been very low. So therefore, we don't think these bond markets look very attractive. But on the other hand, emerging market bonds, particularly local currency like Indian bonds as well, or in certain other emerging markets, the yields are higher, and therefore we think these look relatively more attractive, on the fixed income, from a fixed income kind of or a debt market kind of perspective. And I'll just try and quickly wrap up over the next. We've just got another couple of slides to go, and I've spoken a lot about this already in terms of what our views are. Overall, we think equities, like I said, within equities, Indian equities, we think large caps are looking relatively more attractive as compared to mid and small caps in terms of valuations, as well in terms of return expectations. These are slightly better for large caps from our perspective, and therefore we are sort of slightly underweight mid and small caps versus large caps as such. On the debt side, we think the medium to long term debt segments looks relatively more attractive as compared to cash and short term debt as such, and we remain overweight on the medium to long term kind of debt segment. On the international equity side, I mentioned that US equities are not looking very attractive, so we are sort of underweight US equities in our portfolios vis-a-vis our neutral or our normal allocation. And on the other hand, we think Europe and emerging markets are looking more attractive, and we are sort of marginally overweight in those kind of regions as such. Just quickly talking about the solutions or the proposition that we offer in India. These are a set of 4 multi-asset strategies. These are offered on the PMS platform, and as the name suggests, we are investing across different asset classes, right, into Indian equity, international equity, and fixed income. The idea is that we think that different asset classes offer opportunities at different points of time, right? And if you look back even, say over the last 10 to 12 years, which I was mentioning earlier, US equities have done better than most other asset classes, including Indian equities, right? So that's an eye opener for a lot of people. So in other words, there are opportunities outside of India as well. So therefore, we allocate some portion of the portfolios into international equities such as US, Europe, and emerging markets. Within Indian equities, we allocate to large, mid, and small cap. And again, fixed income, at times it acts as a good cushion when there is a lot of market volatility, as we saw in 2020 or at least early 2020. And so, there is some allocation to fixed income depending on your, risk appetite and your investment horizon as such, these allocations will vary, over times. And again, these allocations are actively managed based on our views. So, as I was mentioning earlier, we think, say, small and mid caps are looking slightly overvalued. So we are underweight small and mid caps, within the portfolios as such. So the allocations are actively managed, based on our views as such. And just to quickly wrap up, if you look at the underlying allocation of the aggressive portfolio, as I was mentioning earlier, this shows the actual allocation versus our normal or neutral allocation. So like I said, large cap is close to neutral, mid and small caps are, if you combine the two, they are underweight as compared to our normal allocation. Again, US equity is a bit underweight, whereas, Europe and emerging markets, we continue to hold a neutral to an sort of an aggressive, slightly overweight kind of a position on those. And if I were to look at the sectoral positions, again, this is based on the underlying holdings in the portfolios. We continue to be sort of overweight on financial services and some of the cyclical kind of sectors like, consumer cyclicals or industrials. These are overweights within our portfolio, whereas, technology and the consumer defensives, we are sort of, we are holding sort of underweight, positions on those. And just to sort of, summarize all that we've discussed, I know we've discussed a lot of stuff and we'll very quickly open the floor for questions. But in terms of key takeaways, we think, obviously, as we said earlier, is that the union budget is focused on capital expenditure, which is the longer term path, right? The easier path would have been to try and give some SOPs and try and boost near term consumption. But the government seems to have chosen to take the longer term path, which will be more productive over the longer term and supportive for the economy and building, stronger growth path, so to say. And like I said, market valuations seem to be pricing in the positive, and the near term risk factors don't seem to be sort of factored in at this point of time. So therefore, we think valuations are a little bit above fair value. And on the debt side, again, return expectations from bonds would be a little bit more normalized, given that we are at the turning point of the interest rate cycle where interest rates are expected to go up. And effectively, this is all that we monitor when we construct our portfolios and position them to reflect, these forward-looking kind of expectations as such. So, with that, I'll sort of stop here and I'll stop sharing as well. And, we can sort of take up questions if there are any. Mr. Sivram, over to you.
Yeah, thanks, Mr. Dhaval. And in fact, it was exhaustive. And first question I'll take, in the backdrop of 5 state election, which is due this year, the general expectation about the budget, it may be populistic, but it is called booster budget now, and government is definitely is not populistic. And what is your opinion about the total opinion about the budget? It was definitely not populistic. And what is your input?
Yeah, absolutely, and that's what we've been talking through as well. As somebody who's a salaried person, we would have expected, some SOPs from a, taxation perspective and things like that. But the government has, like we said, like we just discussed as well, the government has chosen the more, longer term route, right, to boost economic growth, to boost employment. I think, the capital expenditure route is very essential to sort of build. We know we need more infrastructure, we need better roads, better facilities. And through that way, you're also able to provide employment to a lot of people, right? So I think that's the route. The capex route is what they've chosen, and I think that's what they've been doing over the last couple of years as well. Along with the balance that they brought in is spending on the social side. So if you look at education, health, which are essentials for the rural sector, and the lower strata and so on. So I think they've also focused on that. So I think that's where the focus has been. And like you said, there doesn't seem to be anything that's from a populist perspective that's included in the budget as such.
The bond markets are still nervous in India and even in the US. And about 15 lakh crores of government borrowing, and the general expectation of the experts was it will be around 13 lakhs. And 35% of the receipts going for addressing interest payments. Will it offset with better government revenue this year? What is your input? So
obviously, the government is still running a fiscal deficit, right? So you are not the deficit is still there, so which indicates that your expenditure is more than the revenues, right? Or whether it's capital revenues or no, capital receipts rather, like disinvestment. So overall, the balance is still that you are running a deficit, so to say, and which is what. But it seems to be a deficit for good reason or for good measure. So most countries worldwide will run fiscal deficits, but it depends how you're going to spend that money, right? The additional borrowing that you're making. So at least on the face of it, it seems that, and the government has backed it up as also, if you look at the previous year numbers in terms of the actual expenditure and so on, they are trying to spend in the right kind of directions, right? So therefore, in a way, it's a deficit that is essential to sustain India's economic recovery and to take it up another leg or to push it up a little bit further in that sense. And in terms of the borrowing program, it is actually effectively the borrowing is going to be about 11 lakh odd crores. If you look at it's not 15 lakh crores. The gross borrowing is estimated about 11.5 lakh crores or so. If you make all the adjustments in that, and of course it is significantly higher than last year. Last year it was, or the current financial year, it was about 7.8 lakh crores or so. So it is substantially higher, and this is what has sort of in a way spooked the bond market, so to say. So the bond market is definitely concerned. Yields have moved up over the last few days. So I think the government or the market will be closely watching what the RBI has to say in the monetary policy, upcoming monetary policy, which is due next week itself. So the government, the market will definitely be watching out for that. I don't think the RBI will want very big up moves in interest rates, right? Because it will impact what the government is trying to do and what RBI itself is trying to attain, which is sustainable growth rate and so on and so forth. So but one will have to wait and watch in terms of what are the actual steps they take to try and manage that government borrowing program, which the market is looking out for, so to say.
One sole point of last 2 years was unemployment. And do you think the PLI infra push will address the rural employment and will it go up? What is your input?
Yeah, it clearly appears to be the case, right? I mean, I think that's what should happen. If you're building more roads, if you're building more highways or more ports and so on, you will need people to really, you will need labor, right? So I think, clearly it should help rural employment, which is what the government is trying to focus on. So I think, surely in that direction, it will, support the employment sort of purpose or cause as such. Yeah.
And I'm borrowing a tweet of Mr. Kotak. Do you think the balance of near-term imperatives and long-term priorities are matched well in the budget?
At times all of this is very subjective, right? I mean, it's how you look at it. But then if you it's like a bitter pill to swallow, right? I mean, and the government hasn't obviously done much to push near-term consumption. So they haven't, like we said, gone out for softs or tax cuts and things like that, which is sort of very near-term kind of focus. But rather, they are trying to push. They're trying to use the money in the right direction and in a way get that multiplier effect. Like we are saying, it's not just government expenditure, but the way they're thinking is that if they utilize more cement, for example, if they construct more roads, cement companies out here will need to expand capacities as well, right? So that's just one example. Similarly, other manufacturing units will need to expand capacities, employ more people. So I think they're trying to crowd in private investment by using the public investment or government, expenditure kind of route. So the companies that are supplying all of these raw materials or these goods, they will need to expand over a period of time, as their capacities get better utilized. So I think that way, they will create more employment and so on. So the multiplier effect of that can be quite, significant. So in a way, the government has chosen that the longer term kind of path, and if you look back over the last couple of years, right, the last couple of budgets were focused on supporting, providing liquidity support, the support to farmers and things like that. Now, some of those support, some of that support is probably not required anymore. So therefore, they're changing focus a bit. towards other areas. So yeah.
The next question is, markets continue to scale high despite interim minor correction. For example, November 2021, January 2022. Do you think the current market valuation is expensive on the expensive side, or downside risk factors are well priced in?
As I mentioned earlier, we think markets have run a bit ahead, right? So they've factored in fairly strong growth over the next couple of years, right? So therefore, the positives seem to be priced in. The downside risks or negatives, some of them we spoke of, whether it's high commodity prices, the expectation that interest rates might move up, factors such as those don't seem to be considered or don't seem to be well priced in, at least in Indian equities as such. And probably to a certain extent, you're seeing some reaction of some of these factors in global markets, particularly US equities, which have come off. The NASDAQ has come off quite sharply by about 13-15% over the last few weeks. So some of that reaction you're seeing out there in India, I think the correction hasn't been very sharp. But yeah, we think markets are still a bit sort of overvalued kind of territory.
Now I get into your managed portfolios. How important is multi-asset portfolio to total asset allocation for an investor? How important it is?
Yeah, absolutely. I think, as an investor, when you're, obviously you've got certain financial goals that you're trying to achieve, right? Whether it's planning for retirement or buying a house or planning for your child's education, there could be multiple goals that you're looking at, right? For each of these goals, and these goals will have different time periods, right? I mean, you could have some goals coming up over 5 years, 10 years, or 15 years. So depending on the time period, your ability to take risk will also tend to vary, right? So therefore, if you've got a goal coming up in 5-7 years, putting all your money into just equities, or like they say, putting all your eggs in one basket might not be the greatest idea, right? So therefore, it's important to allocate across different asset classes. That is one primary area. The second aspect about multi-asset is that from time to time you'll have opportunities in different asset classes, right? We spoke of US equities. We spoke of, if you look at, different markets have done well at different points of time. So, there are periods when Indian equities haven't done well, like a 2018 or a 2013 or so on. But in those periods, other global equity markets have done well, right? So in other words, there are opportunities outside. It's not just the performance, but if you look at the companies, we use many of these products on our day-to-day life, whether it's the Facebooks, Googles, and so on. That is one part, but Volkswagen, the Toshibas, the Hyundais of the world, all of these companies are listed in different markets and geographies. So therefore, for you to gain exposure to those kind of companies, their scale is completely different to what you have in India, right? So they give you a different exposure altogether. So I would think that's very essential from an investor's sort of perspective.
How multi-asset allotments or allocations will reduce the volatility of the total portfolios among us?
Yeah, no, I think that's a great point. Because I think managing downside risk is also important, right? A lot of investors, when things are going well, people are just thinking of the upside, right? It's when you see some corrections or you see some increase in volatility, it starts impact you. Then you start thinking more about it, right? And managing that downside risk, we think is equally important as well as when you look at the upside. The reason is because the more your portfolio falls or your investment falls, right, the amount you need to recover is much greater. So, for instance, if the value of your investment were to fall from 100 to 80 rupees, right, which is a 20% fall, but to go back from 80 to 100, you need a 25% return. Now, if you were to fall from 100 to 50, that's a 50% fall, but you need a 100% return to go back to 100 rupees. So, effectively, therefore, managing downside risk, and we've seen this historically in Indian markets where the drawdowns have been very sharp. At times, the recovery periods have been long. So, it's taken longer to recover your money because if markets have corrected by 50-60%, which happened in 2008 and so on. So, the recovery periods have been 5, 6, 7 years as well. So, therefore, downside protection is important. And the way we try and do it is two ways. One is diversifying across different asset classes. The second way is buying lesser of asset classes which are looking expensive or which are looking overvalued, and more of asset classes that are looking cheaper. The reason we've seen that historically over long periods of time, that high valuations impact returns, and if you invest when valuations are very high, generally we've seen returns will tend to be lower over the next few years. Not only the returns, but the risk also tends to be higher as such, right? So we try and manage risk by buying lesser of asset classes that are looking expensive and investing in other areas which are not looking so expensive as such. So it's like a valuation driven kind of an approach that we use while managing.
In fact, for the next question you have answered now. The next question was why valuation is important, how it affects the portfolio performance. For that, already you have answered in this previous question. How global exposure of Morningstar helps for international diversification, how it mitigates the risk of the portfolio.
And as I was mentioning earlier, just to quote some other examples, if you look at the global equity market as a whole, right? I mean, India comprises maybe about 3 to 3.5% of global market cap. So there is a 95-97% of market cap that's sitting outside India, right? In some of the companies that we spoke of earlier. So there are multiple opportunities outside. Even if you look at from an economic perspective, India comprises about 3 to 4% of global GDP, right? I mean, US comprises the maximum, which is about 25%. China comes next at about 11-12%, and then you have Japan and Europe and so on. So in other words, if you look at it from an economic perspective or from a capital market perspective, India is still, although it's growing, but it's still a small component, right? So therefore, there are multiple opportunities outside. I mean, the US equity markets comprise more than 50-55% of global market share, right? So there is a significant set of companies which are multinationals, and we spoke of them, we know of them as well. So I think, one is these opportunities. The other is we've seen that all markets don't move up and down together, which is what I was referring to earlier as well. So periods when Indian equities don't do well, these markets might be doing well because their drivers are different. What drives their economy and their companies are different from what drives Indian corporates and the Indian economy. So from that point of view, we refer to it as a low correlation, right? And the third factor being the foreign exchange factor, right? I mean, as the rupee depreciates, you gain more from international investments because you get more rupees for the same dollar that you invested, in the past as such. So, and as we anticipate inflation in India will be higher, the rupee may continue to depreciate gradually over a period of time, particularly versus the US dollar. So again, foreign investments give you a hedge against, foreign currency, as well, from that perspective.
See, the last question for the day. How to choose from different propositions you have depending on the market condition and the client preference? How do you marry the client preference and different propositions you have?
Yeah, so if you look at, I mentioned that we offer 4 strategies like a balanced growth, aggressive and aggressive plus. So each of these are suited for different investment horizons and different risk appetites. So somebody who's got a 5 to 7 year horizon with a moderate kind of a risk appetite can opt for the balanced strategy. Somebody who's got a longer term horizon, higher risk appetite, they can opt for the growth or the aggressive plus kind of strategies as such. So what we do is we try and support, we help investors to select these portfolios through a risk profiling activity. So there is a risk profiling questionnaire where we will capture their, their risk taking capacity, their investment horizon, how have they reacted during different market scenarios, to try and understand their risk-taking willingness, and then accordingly, identify a portfolio that might be suitable to their, to their needs and to their risk appetite as such.
So Dhaval, that's all. And in fact, thank you very much for your time. And I thank all the investors who have joined in this webinar also. PMS Bazaar, on behalf of PMS Bazaar, I want to thank all of them. Thank you, Mr. Dhaval. Thank you, participants. Thanks.